Johnson & Johnson is a global healthcare company operating in pharmaceuticals, medical devices, and consumer health. They develop prescription medicines for conditions like cancer and autoimmune diseases, producing surgical equipment and devices like joint replacements, contact lenses, as well as selling popular consumer products like Tylenol, Band-Aid, Neutrogena, and Listerine. Now, if we just have a quick look at their latest quarter, we can see the makeup of their revenue. In fact, the vast majority does come from immunology, around 4.6 billion, but we also see other areas as well, infectious diseases, neurosciences, and in fact, oncology at around 5.4 billion. Now, looking at the company itself, not looking great at all. Down 11% over the last year, and over the last 10 years, it is up only around 38%, massively underperforming the S&P. So is this Dividend King a great buy now, sitting at its 52-week low? Now we get a double buy. Both Seeking Alpha and Wall Street do believe this is one you should have in your portfolio, and we also notice a fairly attractive starting yield at 3.44%. We do also have to look at some of the challenges they have encountered in 2024. They face ongoing legal issues related to claims that its talc-based products have caused cancer, and in an effort to resolve these lawsuits, what they have done is done multiple attempts to channel the liabilities through bankruptcy proceedings. In their third attempt, they did in fact propose a settlement value of around $8 billion, which is to be paid over 25 years, securing support from around 83% of claimants, and this legal uncertainty has continued to weigh down on investor sentiment, which, as we can see from the share price alone, isn't looking too good in 2024, and the same to be said at the beginning of 2025. Now, the issues don't stop there. We have also noticed their medtech segment did face some headwinds due to economic slowdowns in Asia, as well as a physician strike in Korea, which affected their sales growth. However, despite those challenges, in their latest quarter, Q3 FY24, they did report around 6.4% operational growth in this division. They do also have other costs to bear in mind. The acquisition of V-Wave, a privately held medical tech company, did lead to a special charge that impacted their financials, and they did have to account for their full year profit forecast for these costs, which also did influence some of the investor perception that we have seen about this company. Despite the bad news we have heard from Johnson & Johnson, their latest earnings was fairly decent. They did raise their sales outlook, but do bear in mind they have lagged the S&P for quite some time, something we will show you, and these factors contributed to a complex landscape for JNJ in 2024, with legal challenges, operational hurdles affecting investor confidence as well as stock performance. Now, we're also going to show you their earnings moving forwards. They anticipate out of the next 4 quarters, only one of them to be growth, in fact Q3 2025, but we do notice over the last 4 quarters, they have outperformed analyst targets, 100% track record. Now, what is their forward PE? Well, EPS for the full year 2025 at 10.64 does give this right now a forward PE of 13.55. We're going to show you that is lower in essence than their 5-year average, but also significantly lower than the S&P 500. We also have a quick snapshot of their latest earnings. Now, their sales up 5.2% from the same quarter last year. However, we do notice their earnings per share is down, as well as their adjusted EPS. So something just to bear in mind, we do understand this company has faced a lot of difficulties. They aren't in the strongest position right now in terms of investor sentiment, but it could be a great opportunity to buy this undervalued Dividend King. Now, dividend safety score, 99, very safe. We love to see that. We're going to cover these two shortly, but these represent severe undervaluation, and something that we're not too happy with is the dividend only increased by around 4% last year. That is pretty much in line with inflation. Now, good news, as typical with this company over the past period, they are giving a very safe score reaffirmed in October last year. This ultimately means a dividend cut is highly unlikely. Now, some key metrics from the last recession, the 07-09, they increased the dividend. They had above average growth, -6 versus the S&P's -12. They also massively outperformed the S&P, -27, the S&P itself, -55. Not the greatest increase last year. Over the last 5 and the last 20 years, we have seen a lot better. In fact, high single digit on average just over this period. But as we mentioned, they're a dividend king. 50 plus years of increases consecutively whilst paying a dividend without a reduction. Now look at the first model based on the 5-year average P/E ratio. When we zoom into over the last 12 months, this blue tunnel gives us the signal for the intrinsic expected fair price. Now right now, something we have seen a few times over the last 12 months, it is trading even lower than the bottom end. This is a signal of severe undervaluation, but do remember we're going to run it through our own valuation process shortly, so we're not looking at any of these models in isolation. Then we get to dividend yield theory, telling us a company is undervalued when the current yield sits above the 5-year, 3.47, well above the 5-year 2.73, but also above, in fact, every single point over the last 5 years. So you are getting right now the highest dividend yield over the period. This is a severe undervaluation signal. Likewise, the forward P at 14 sitting below the 5-year rolling, another signal that this company looks heavily undervalued. We do also notice that right now it is trading at a discount to the healthcare sector, which sits at 15.3. In terms of our first underlying metric, the free cash flow per share, which as always we do focus on this channel rather than the earnings, which is susceptible to manipulation by management through accounting. Our blanket rule, 60% or lower, give us faith management can increase dividends at least above the inflationary 4%. Over the last 2 years, not great, above 60%. Nice to see over the next 12 months at 61%. So ideally, we do want to see a high single-digit increase this year. Then we get to free cash flow, consistent increases over the longer term. Not something we get in terms of massive growth, although it has increased. What is good to see, though, over the next 12 months, a large jump to $8.19 is anticipated. Then sales growth at a bare minimum 3 to 4% just to keep up in line with inflation. Now very inconsistent, although good to see in 2023 and the expected 2024 based on the trailing 12 month, it is anticipated to increase their sales by at least inflation at the bare minimum, and we can see that right now through the numbers below. And as always, do understand the type of companies you are looking at, have realistic expectations. We shouldn't expect growth from companies like Microsoft or Nvidia to that of Johnson & Johnson, and that also shines through in the numbers. Now, shares outstanding, we highlight this. We want to find companies that also return excess cash to investor pockets through those share buybacks, something they have done over the longer term, but some years very inconsistently, other years they have done a lot of buying back, and the most recent period are one of those years. In fact, from the trailing 12 month to 2023, there has been quite a significant number of shares, and this is one indication right now that perhaps management do believe that Johnson & Johnson is undervalued, and that is why they are buying quite a number. We then move on to the ROIC, where we want 10% or more to give us faith management are able to effectively allocate their capital. Looking very good, consistently very high. Nice to see 21% on a trailing 12 month. And then when we get to the operating margin, not only above the 12% is what we want to see, which is what we get, but we also want to identify, are there any efficiencies? Has the margin been increasing? Which it hasn't, but good at least to see the consistency year on year. And the same to be said for the free cash flow. Very, very good. You could call Johnson & Johnson a strong free cash flow machine. Then we get to the net debt to EBITDA, which signals how strong the balance sheet is as well as dividend safety. We want below 3 for the majority of companies, and the numbers you see below are the number of years it would take the company to pay off all of their debt net of cash on hand. 0.51 on a trailing 12 month, looking very good. Balance sheet looks good. We did see a very safe dividend score as well. We'll highlight this as well through the balance sheet review, but no worries whatsoever. Metrics as a whole are looking very positive. Now, we want to let you know we have just released today our latest free weekly article covering 2 cheap stocks to buy this month. Now, we release one every single Monday morning to your inbox where we cover severely undervalued stocks as well as what's gone on the market over the last few days. So click below, you can sign up, read straight away, where you'll also be able to gain access to 46 undervalued stocks for the month of January. And we also take a look, not just a lot of information, but also what Wall Street themselves believe in terms of upside over the next year. And you can also grab a copy of 29 stocks that Wall Street themselves believe have the most upside in the S&P 500 right now. So click below, you can sign up and start reading straight away. We then look at insider ownership that sits around 0.16%. We get around 10 million worth of sales by these insiders over the last year, with only a little bit of buying in comparison at 147,000. Now, latest quarter of 2025, no buying, no selling. Q4, we get a little bit of buying. So actually the most recent movement were insider buys, and Q3, we get just under 1 million worth of sales. Now we'll take a look at these insider buyings as well as insider sales, but the most recent one was on the 12th of December, which we do believe to be a bullish signal. Insider buying 147,000, though you could argue this to be a little bit trivial, but the information is here if you do want to incorporate it into your own investment thesis, into your own analysis. In terms of institutions, 70% ownership, 16 billion worth of sales over the last year, with some more buying around 19.2 billion again during the same time frame. And then the most recent quarter to end out 2024, we got a lot of buying in comparison to the selling, and the same to be said in Q3. So institutions clearly buying a lot more than they are selling. They are bullish, but as always, do your own due diligence. Never copy what insiders or institutions do. Now, in terms of the income statement, we already covered their top line. There is growth, maybe not a massive amount, and probably keeping up in line with inflation, but we want to see, does the bottom line net income tell us the same story? And a lot of inconsistency. In reality, it doesn't actually follow the upwards trend of the revenue. Something to think about. We actually got 35 billion in 2023. Based on the trailing 12 month, it is estimated to drop more than half. We then take a look at the balance sheet, which we did say looked fairly healthy. Quick total cash versus total debt comparison, and we see the cash has decreased over the longer term, 33 billion in 2014 to around 20 in the latest quarter. But as always, we never look at one of these models in pure isolation. We do like to compare it to the total debt numerically and directionally, otherwise one number won't tell us anything. So total debt, actually unlike cash, has been increasing over the period, 19 billion in 2014, 36 billion in the latest quarter. But as we saw from the net debt to EBITDA, it does look fairly healthy, and there are no worries at the moment with either dividend safety or the general health of the company. Now, when we take a look at the cash flow, we just want to point out how much cash this company generates from their operations, which over the long term has looked fairly consistent, although increasing from 19 million to 25 on a trailing 12 month. And then we like to look at some gradings. Now, the first one is valuation, where they get a D+, although as we mentioned earlier, when comparing their PE on a forward basis against the sector median, they are trading at a discount. Right now, if you're buying this company, you're paying 28% less than the sector overall, something that is pretty much here reinforced in the majority unless you do look at the price to book. Again, will depend on which valuation metric you do like to use. In terms of the growth, now they get an F, 5% year-on-year revenue, sector 7.6, forward-looking -1%, sector 7.6, and the main thing we really want to take away from here is the earnings per share expected to grow at 6% over the next 3 to 5 years, with the sector comparative at 10.64. Having said that, profitability does look very good at an A+, 70%, sector median at 58%, bottom line 17%, sector actually losing money -4.5%, and the same to be said on cash from operations, impressive from JNJ at 25 billion, with the sector comparative burning through -15 mil. So quick conclusion here, double buy from Seeking Alpha and Wall Street, D+ on valuation, F on growth with an A+ on profitability. Now, quickly, two things before we jump into our own valuation process. Comparing their performance against others in the pharma space, lots of very well-known names, total return including dividends reinvested, they're not even one of the worst performing, -8%. That tells you this pretty much has been a very bad industry to be invested in over the last year. In fact, out of these, only AstraZeneca is up, and that is barely even 1%. When we zoom out though, over the last 5 years, we can see for Johnson & Johnson in particular, very poor performance, up only 15%. And over the last 10 years, they're up only 82%, but you would have had to select only a few of these to have a really good performance. The majority not doing that well, in fact, significantly underperforming the S&P 500, which is what we also want to show you here. Over the last year, no surprises, J&J underperformed. Over the last 5 years, the same conclusion, and over the last 10 years, again, massive underperformance. So when you are considering this company in your overall portfolio, don't forget to consider whether you believe it will outperform over the longer term. Now, jumping into our valuation, our intrinsic value, $175, is the average of these three models today. Now, we'll just run through each one, the first one being the multiples valuation. Although do remember, we aren't looking at any of these in isolation. We have companies in a similar sector and size. We have their average PE, that EPS of J&J, giving us our first undervaluation signal. Then we move to the dividend discount model, where we have the dividends growth year on year, 5.5%, forward looking a little bit lower to be on the conservative side, giving us our third undervaluation. Then the DCF model with the free cash flow growth year on year. Now we have gone fairly low at around 6% moving forwards. With the growth rate, we have the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and our third undervaluation, 3 for 3, average $175. But do remember, we don't stop there. We always add a margin of safety that starts at 10%. We execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Now, if you believe that, in today's episode, a buy at $157, and we keep going till it's near the current trading price. Now, right now, around the $140 mark, you're getting a 20% MOS, so you could argue sitting somewhere between 15 to 20, although near enough 20%. Wall Street themselves did give it a buy rating. $174 is what they see in a year's time, translating to 22% upside with a yield that is sitting higher than the 5-year average, and in fact the highest it has offered over the last 5 years. It is also a dividend king, so do give us your thoughts in the comments below. Now do bear in mind that while Johnson & Johnson has demonstrated some strong financials and there is a buy rating from the majority of analysts, potential investors do also need to weigh in the fact the company's ongoing legal challenges given their recent stock performance relative to the broader market. And as always, you need to do your own due diligence to see if it fits into your overall investment thesis. As always, give us your thoughts in the comments below. Don't forget to sign up to the free weekly newsletter, grab those 2 spreadsheets, and come and join us in a Patreon where we do cover our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.